Well, when I hear the introduction, I come to the conclusion that I can't just seem to hold down a steady job.
Well, you have a very steady one here, I would like to say. And
Oh, you said this is recorded, right? Okay, good.
yeah, I'm on record. And
All right.
so are you inviting questions or comments during your talk, or do you want to wait to
I think with such a
chat?
small group, we could probably handle them inside the talk.
Okay.
And I need you to enable the screen sharing, if you please.
Oh, shoot. Yes, I will do that. Okay, now it should work.
Okay. So first of all, thanks to everyone for coming. This is a topic I've been working on for something like 20 years, which seems like a terrible thing for an academic to do, but it's a really good thing for a consultant because you can charge by the hour. My topic is the valuation of contingent corporate claims. And I want to convince you that not only is this problem different from other types of contingent valuations, but it's really very interesting, and it presents some interesting problems that we don't run across in the typical high-powered mathematical treatments of the topic that we often see during this seminar and in our academic venues. So I'm going to address the question of how to value contingent claims in natural ones that arise in corporate situations. And the ones that arise are quite complex and in ways that are surprising and ways that the ordinary CAPM can't anticipate and ordinary derivative models can't anticipate. But I'm going to claim, and you can maybe prove me wrong or prove me right, whatever it is, I'll take it, but show you that you can value the liabilities of a balance sheet as derivative contracts against the underlying assets of the balance sheet. Now we're going to use that derivatives technology, but we had to make a couple of important corrections to the technology before we can do it. So here's the basic problem. In most contingent claim valuation models, which you're all familiar with, the derivative payout is a known function of the prices, the cash payouts, the price paths, or terminal prices of a number of assets or contracts. You can define most derivatives that way. Not all of them, but you can define a large number of derivative contracts that way. There might be also some that have an optimization feature like an American option or some kind of optimally exercised trigger. And in all these cases, I remember as a graduate student thinking it was so great, in 1985 when Coxinger, Saw, and Ross came out and they offered this paper that said, hey, you can value all these things in the risk neutral context. All you have to do is take all the assets or contracts in there, replace the growth rates with the risk neutral equivalents, determine the expected cash payouts of the assets under this risk neutral measure, and discount the payouts at the risk-free rate to find the value. And it seemed like almost everything fit into this framework. I really was, a very great proponent of this model in my consulting work to introduce this idea of applying these valuation techniques for corporations and the components of their balance sheets. So why does corporate cash flows present problems that are different than other sorts of cash flows? And for some of you, that may be obvious if you've worked in this space, and for others, it may be a new thing to think about if you're used to thinking about continuous time models. First of all, corporate rules are not usually determined by the values of assets. They're usually determined by the cash flow levels and cash flow allocation rules. So we don't have present value to rely on. So we say take the asset and replace its growth rate with its risk neutral equivalent. You can't do that because you can't see the asset, right? You don't know the valuation, right? How are you going to get a risk neutral equivalent? Even if you do, come up with a present value, these assets on the balance sheet, the projects which comprise the assets on the left side of the balance sheet, are probably not going to be separately valued. You're not going to be able to see the value of those assets, right? They're not traded typically. The liabilities, maybe some of them are traded like equity, but others like debt or, say especially bank debt, or things like the government claim on your tax income, which is a liability, or other things like employee claims on the assets of the firm are not traded and not visible. So you can't just value these things and just sort of plug them into the standard derivative frameworks, even one as complex as Coxinger, Saw, and Ross. Third point is that cash flow means and variances evolve in very dynamic ways. With cash flows, we have things like momentum, we have mean reversion, and even simple random walks in cash flows, which provide complex covariance structures across time in the cash flows. You know how taxes have, carry forward rules, for example, look back rules, compensation contracts are famous for this, right? You have to performance for a number of years in a row in order to get some kind of cash payout based on your profitability. These are all cash measures. None of these are market values of assets, right? So even to take cash flows, if you want to assume they follow a simple random walk, that really implies a very rich covariance structure of the cash flows across time, even that very simple example. So the trick that most people use, at least in practice, of taking the CAPM and applying it to multiple periods is a miserable failure, right? And for a couple of reasons. The main one being is that when you apply the single period CAPM across multiple periods and you assume a constant discount rate, what you're assuming is that the risk resolution in every period as a fraction of the asset value is the same. Okay, the risk premium is expressed as a percentage, right? It's saying that the risk resolved in that period is a percentage of the asset value in the beginning of the period. It's a highly, highly restrictive model to say, I can take this single period CAPM and convert it into a multi-period CAPM by assuming some innocuous sounding assumption like a constant investment opportunity set, which is what some economists do, right? Effectively repeat the single period CAPM in many periods. And even Merton's continuous time CAPM has that flavor. You don't really have the flavor of a multi-period model because there's the relationship between value from one moment dt to the next, right? If you assume that relationship is constant, you just have a repetition of one period models, right, in continuous time. So it's not surprising you to get the same kind of results in Merton's CAPM that you would in a one period CAPM. Because that model, when you have the constant parameter version, is just a repeat of the constant opportunity set CAPM continuously in time. Okay, so we have to worry about the fact that there's correlations in cash flows across time. When a company has a momentum in cash flows, right? It's on a winning streak. We see a positive correlation. If they're on a losing streak, there's a positive correlation in the cash flows over time. If there's mean reversion, the variance is changing over time. Right, so all of these things are going to make it very difficult to value cash flows, which, to make things even worse, are not even seen in continuous time, they're seen in discrete time, which means they can have much richer correlation patterns than the things we see in continuous time. Unless we painstakingly define them to create those kind of patterns, it's very difficult to create cash flows that are negatively correlated sometimes and positively correlated in other times when you simulate a continuous stochastic process.
Yeah, just a clarifying question. So if I wasn't as smart as you and I only knew about a single period model, could I just assume IID and then I realize that's a strong assumption, but anyway, does it not accomplish the task of converting a single period model to a multi-period framework?
It does, but it's under the assumption of having a zero, a covariance matrix with the zeros off the diagonal.
Yeah.
Right. And so
right.
that might be 100% appropriate for certain types of assets, right?
Okay.
And it could be completely wrong for other types of assets. So
Okay.
I'm not complaining this. I'm not claiming this model is going to solve all valuation problems. The real problem I'm tackling is the one that I constantly faced as a consultant, which is that I would work for an energy company. They would say, look, we have 100,000 different geological scenarios for this oil field, and then we have 1,000 different price scenarios. Right, and we want to simulate all these together and figure out what the value of these cash flows is.
Okay.
Right. So the volume itself can create these kinds of intertemporal correlations in the revenues. Right. The prices are going to be correlated in their own way, in ways that we typically understand and are comfortable modeling. But then you multiply price times volume, and you have these very complex processes.
Okay.
The other reason that I've had problems in the past trying to apply these models is that it's not like you just do a valuation of the firm's cash flows and you have some of the firm's assets or liabilities are traded that you can use as benchmarks to that. The thing is, you're doing evaluation because you're doing an experiment. You're saying, should we, should we make an acquisition? Should we undertake a, a long-term hedging program? Should we do these kinds of things that are going to have profound impact on our cash flows, right? So we might want to do a market valuation, but include information that's private to the corporation, right? Have a private valuation instead of a public valuation model. We might want to look separately at the impact of, say, fluctuations in the assets compared to fluctuations in investor temperament that also cause changes in the prices of these assets. And the company may be private in the first place, have no public valuation, in which case you're kind of out on a limb to try to find some benchmarks to value these cash flows. Now, last year I presented what I call the structural model for the CAPM. I'm just going to repeat 2 slides from there. I know there's a couple of people here from last year, so I don't want to dwell on this too much. But the idea of this model was that you could actually think of the CAPM as being the second stage in a equilibrium modeling process. Why? Because it's kind of a reduced form model. The way it begins is you're given expected returns, standard deviations, and correlations, and you're asked then to find the optimal portfolio. And then at the end it says, and we assume that this is in equilibrium. So you had to choose the equilibrium values in the beginning to get there. So it seems to me like a kind of a circular thing. How would I know in advance what those equilibrium expected returns and standard deviations would be? So I took a step back and I found out that this is exactly how Lintner and Mosine, 2 of the co-founders of the CAPM, did approach the problem. It just never got as popular as the Sharp version of the model. And what they did was they modeled cash flows instead of returns. So let's assume we have a bunch of 1-period assets. These are firms that deliver a cash flow in 1 year. We know the means and standard deviations and the correlations. And then you can solve for the equilibrium value of those assets. And this is the pricing equation, which might be a little bit hard to read for the unfamiliar, but it basically says it's a certainty equivalent valuation. We take the expected cash flow, we subtract the risk aversion coefficient, which turns out to be the Sharp ratio, by the way, or the Sharp ratio with variance in the denominator. Multiply it by the covariance of the asset, the dollar covariance of that asset with the market. Okay, you take that as a risk, certainty equivalent, discount that at the risk-free rate. So it turns out this formula, although it looks very different than a CAPM style evaluation, actually leads to exactly the same CAPM equations. So this gives us the expected returns. I didn't put the slide in here, but it gives us the expected returns and the standard deviations that we can plug into the CAPM. And those, in fact, are the equilibrium ones. So when you solve for the optimal portfolio weights, you actually get the value weighted portfolio that's generated by this cash flow model. So I call this the structural model because the parameters expected return particularly are endogenous to the model. We had a couple surprises. And again, this is advertising last year's talk, so I apologize for that. But as I said, the CAPM specifies return statistics exogenously, then requires them to be in equilibrium. The cash flow portfolio model, the structural model, determines expected returns and covariances endogenously. Okay, and those happen to be the same ones that are the ones that get you those market equilibrium results in the CAPM. Okay, exactly the same results to the letter, but the point is that now you can say, aha, this is how I calculate expected return. Expected return, as it turns out, is a function of the total risk of the asset. It's not that risk is diversifiable. Risk is part of the overall market risk adjustment. So we get some really big surprises with this model, and I don't want to go through all of them, but the point is, it looks like a completely crazy approach until you realize this was actually more like the prequel to the CAPM. This is what had to come first in order to get the results of the CAPM in one way or another. Okay, and lots of people have re-derived this over time, but they work backward from the Sharp version of the CAPM into this version, the cash flow version, and that's how they get some of these valuation results. So since last year, I found another big surprise. Just by rearranging the terms of the equations, you notice how the value of every single asset depends in a simple way on the risk aversion parameter A. So what I can do is just take let's say I have a market portfolio that has like a large number of assets. And now I take any 2 portfolios of those assets. So just simple linear portfolios. then the value of those portfolios, and think of this one Y vector and one Z as the selection vector, the one that has ones in the assets that are in that portfolio and zeros otherwise. So what I can do is I can say I want to take asset Y, which is a bunch of ones and zeros, right, multiplied times the assets in the market portfolio, and then I have this portfolio Z, which is a different combination. I solve them both for A, right, because I can do that. Just it comes through as a constant, and then set the two equations equal to each other, rearrange terms, and what do I get? In this cash flow version of the capital asset pricing model, you get the value of portfolio Z is equal to a beta times the value of portfolio Y, plus this looks like a intercept in a regression, right? Intercept divided by 1 plus R. So it's intercept plus slope. We get a linear equation. So it says that in the cash flow version of the CAPM, the value of assets are linearly related through this equation.
Yeah, let me make a comment. So there's the CAPM and the CFPM. And let's say there's also so-called one-factor model, where the one factor I'm allowing to be anything.
Yeah.
And I'm thinking what you're telling me now works in a one-factor setting.
That's right. In fact, I've often emphasized, to clients or students that I'm not necessarily using a market portfolio here. I'm using this V as the reference portfolio. Okay. And I can always say I'm valuing this asset relative to this reference portfolio. So if I'm talking to a venture capital firm, for example, I can say, well, here's how I can value this asset relative to the S&P 500, but here's how you can value it relative to your own portfolio, and those should be different, right?
Yeah.
So I looked at this equation and said, wow.
Yeah.
What's that?
So we see you have replicated in quotes, which is suggesting it's not the usual sense of replication.
Yeah, it's not the usual sense of replication, right?
Right.
And in fact, at first when I did this, I thought this is crazy. This would mean that I could write the value of Google as a linear function of the value of Apple.
Yeah, in a one-factor model with no idiosyncratic terms, that would be true. Yeah. Okay.
So yeah, in fact, it's obvious from the math, right? There's no heavy math here.
Yeah.
But it just gives me a different way to think about, stocks, about pairs trading, for example. I think this will have an application there. And it's not that different from what you get in the CAPM. We just don't usually see it written this way. We don't usually see a replication equation when it comes to share prices. But just like I could say, a call option on Google is equal to a hedge ratio times, a call option on Apple is equal to a hedge ratio on Apple times the value of Apple plus a intercept term as well.
Right.
So this gave me the idea, okay, maybe there's hope. Maybe I can fit an option pricing model into this. So that's what I did next. Remember, the cash flows are normally distributed in this model, so it's not going to be a Black and Scholes. So if that was your hope, then forget about it. This is going to be more like a Bachelet model. We'll, of course, assume a European call, no dividends. Market value of the portfolio in 1 year is normally distributed in this model. So I have two assets. I have the market portfolio or the reference portfolio, and I have the call option. But now when I do the market clearing conditions, we have to remember that the assets in the market have to have a weight of 100% in the market. They have to be fully subscribed, right, at their price. But derivatives are in zero net supply, so the net number of contracts in existence must be zero. Believe it or not, that has pricing implications. So it means that when I price the asset, right, I take this, I take the mean cash flow, subtract the covariance with the market assets, discount the risk-free rate. That's my risk charge, discounting the risk-free rate. In the case of the call option, what I'm doing is it turns out the same thing, but there's no term for the variance of the call. This actually disappears. Right, so that one disappears because of the zero net supply condition. But anyway, you don't need to worry about that so much. It's just a different definition of covariance. It's the covariance of the call with the elements of the market portfolio, not with other derivatives or itself. But the formula looks quite similar, right? Sigma C is just the covariance with the market elements, and sigma here is the covariance of the traded market elements. So that looks very promising, right? Looks like the Bachelet model, in fact, because it's normal distribution, And so we should not be surprised to get that kind of result. So let's calculate it. So if the value of the market is normally distributed, we'll call that V at time t. Got a mean of mu and standard deviation of sigma. And then we have a call payoff at time t. And if V is normally distributed, you can calculate these two statistics. And I didn't really get this beforehand, but now I was really surprised. The first one didn't surprise me that much. Expected value of the call can be expressed as a function of the cumulative normal and the marginal normal distribution as a function of D. D is like a standard deviations away from the strike price that the underlying is, the mean, I mean. But the covariance is equal to the covariance between the call payout and the value of the underlying at maturity is sigma squared n of D. And I had no idea that n of D was like a covariance term, but it is. So when we actually solve for this, we put this together. We say using that formula that I just gave you on the previous page, I take the expected value minus the covariance charge, discount the risk-free rate. What do I get? Expected value of the call at maturity minus the risk charge times that covariance divided by 1 plus R, which simplifies to the value of the underlying market times n of D. Looks like Black-Scholes style, right? Minus, and there's a present value of another term, right? This would be the payment, of course, the strike price, and this is the adjustment for the normal distribution. But what I'm getting here is in the CAPM, it appears I'm getting linear replication of the option payout.
Where did the A go in the second equal sign?
So it turns out when you calculate all these terms, there's in the expected value of CT, there's going to be this term mu minus X, right? And then you have this other term, which is A, and the A terms actually cancel from the regression, or sorry, from this equation when you put them both in together. So just like Black-Scholes, right? The risk premium disappears because it's part of the expected capital gain, and it's part of the part of the risk charge, right? Expected capital gain and the risk charge, and those two pieces cancel each other out.
Like I'm thinking we should are we able to take what's on the slide and actually derive the final result?
Yeah, it's not hard. It's not hard. I mean, I'm nervous about doing it off the top of my head, but it is a small audience, and a friendly audience, so I don't think they'll eat my head off, which is very nice. But let's see if we can do this. So expected value CT is going to be, right? That's mu minus X times n of D, right? Mm-hmm. Plus sigma times little n of D. Mm-hmm. Minus A times the covariance, and the covariance is sigma squared n of D. And then discount the risk-free rate. So let's forget about that, right?
Okay. Sure.
So you have mu, right?
Yeah.
Minus A times sigma squared n of D.
Yeah.
Right? But the underlying asset is equal to the value is, based on the previous page, mu minus A sigma squared.
Okay.
Right? Times n of D. So that's how the terms cancel, is that you offset the expected return with the risk charge.
Okay.
Which is really cool, right? I thought, wow, this is fantastic. This is wonderful. Except, of course, I wasn't the first person to find it. I often find that in my research.
Okay. Okay, thank you for clarifying. Okay.
Okay.
Yeah.
So, but this nice surprise, that n of D is like a covariance term was really eye-opening for me. I thought that was really cool. So I ran this like I do with all my models. I want to make sure I have the right results. So I ran it through Excel. And I found that it worked really well sometimes, this Bachelet model that I calculated. But if I increase the volatility too much, or I increase the strike price too much, or I lower the stock price too much, there are lots of times when I got these really miserable option values. And I think, Peter, you commented this to me like 3 years ago when I first came here. And I said, we could use this to price options. And you said, yeah, but it gives negative values sometimes.
Yeah.
And so I proved that, right? It gives negative values. And then there's a region in the pricing function, which is also non-convex. So we have all sorts of arbitrage, and not just dynamic arbitrage, which is not defined in this model, but even static arbitrage, right, with these prices. So what's wrong with the model? And this I struggle with, is how to resolve this problem. Are these fundamentally incompatible, the Bachelier and the CAPM? Well, they were famous financial economists, and I think you probably, I know Peter knows all these people, and I bet a lot of you two do, the rest of you as well. But look at the title of this paper by Jarrow and Madan. Is mean variance analysis vacuous, or was beta stillborn? And this is what they were talking about. So you couldn't see, it didn't seem possible to reconcile the mean variance model with the derivatives pricing. And then Dybvig and Ingersoll came along. This is a very young picture of Phil, I guess. And with the Journal of Business paper in 1982, they have this nice result, mean variance theory in complete markets. And they show that, you know, this type of modeling, even if you use log normal distributions and then Black-Scholes type functions, you still get this problem where you can't really apply options. Well, I think I found the solution. That's the first contribution of my paper.
Good.
So I'll ask you a question, Peter. We're making this a participatory seminar here. What would Merton have found if he didn't discover or impose the self-financing condition for the options?
Well, I mean, I guess he would have found a way to value non-self-financing portfolios. Is that what you're looking for? It's not very deep, but it's at least true.
And you know, the more I read about this, I'm always scared to pick up a paper by, like, you know, Harrison or Krebs, because those guys are scary smart, you know. But there's one paper where they talk about the fact that this isn't mathematically or economically strictly a needed assumption.
Right.
Because if you don't have a self-financing portfolio, there's no reason you can't just take the extra cash flows it throws off and value those, right?
Right. Agreed.
So what is the fundamental reason why you have a self-financing condition in the continuous time option models? It's because there are too many solutions to the differential equation.
Well, I would say
there's an overspecification of the model.
I mean, I would phrase it as Merton was interested in valuing a call option. Let's look at the cash flows of a call option. When you buy it and until it matures, there are no cash flows, zero. Yeah. Okay, so the self-financing condition was, you know, a foreign portfolio stock and bond, and you're trying to match the cash flow of the call, which is zero, you know, prior to when it matures. So that's what makes it self-financing.
No, that's really a great thing, and it's good that worked out. But it also gave like a unique solution to the problem. Yeah. And in discrete time, it turns out if I do exactly the same thing that Merton did, even though there's no continuous trading, if I quote unquote impose the self-financing condition, I get the result that I have to adjust the mean to be equal to its risk neutral value for the formula to work. Or I can assume simply that I have an equilibrium model, the CAPM, but I'm going to require in addition that there's no static arbitrage allowed, because that wouldn't be part of a CAPM anyway. So if I derive the CAPM with a constraint that there's no arbitrage, that also gives me risk neutral pricing. If I require, any one of these would give me the same result. If I require that the partial derivative of the option price with respect to that D term in, the D is the argument for the big N or the little n. If I require that equals 0, that also creates the result. And finally, if all I do is say that the option prices have to be convex, if they're available for all strikes, and I just make that one condition, the only way to make them convex is to make the mean equal to the current value of the asset times 1 plus R.
That's a new result. I haven't seen that anywhere.
Yeah, I think that this is great, right?
Yeah.
So this is the risk neutral value. And this is the adjusted price in the previous slide. And it's very clear, at least in the discrete model, that we have this overfitting, because we're talking about mu, right? The expected cash flow and the value as if they're different, right? As if they're separate degrees of freedom, but they're not. They're fundamentally dependent on each other. So you can't have a model where you specify the stock and the expected return simultaneously.
Okay. What's the, you have require that del V C del D equals 0. I guess I've lost what D is.
Yeah. So you know in Black-Scholes when you calculate the delta and you get those other terms, like you get the easy derivative, which is like, you know, Sn of D, then you get, okay, n of D. But then you have to take the derivative of S, which is 1 times the derivative of capital N with respect to S.
So what's D again?
I can't believe I'm doing the Black-Scholes equation for Peter Carr, but I'm going to do it.
Okay. I'm just asking what the meaning of D is. Oh, it's the argument of Q norm? Is it? I don't know. What's D?
In the Black-Scholes way, this is I meant for your Black-Scholes, but in Black-Scholes, when you take the partial C with respect to S, right, you get N of D1 is what we're used to thinking, but you might have remembered that when you first did this, you said, oh, that's also there's S times little n of D1 times the partial of D1 with respect to S, right? Then minus, not plus, minus x e to the minus RT little n of D2 times the partial of D2 with respect to S. So, and you remember that you can make this equal to 0.
Yes.
That's what this is. The partial with respect to the argument.
The last two, so what you mean by this del VC del D equals 0? The last two terms of these 3 terms is equal to 0? Yeah. That's what you're saying?
Right.
Okay. Okay.
Okay. So I think it's a nice result in itself, but we're still in the 1-period model. We've got to evaluate corporate cash flows, which are multi-period. But let's summarize the 1-period.
Oh, now I follow what you're saying. Okay.
Yeah.
All right.
So we determined the CAPM, just a summary now, nothing new. We determined the CAPM parameters endogenously by starting with a portfolio of single-period, normally distributed assets. And all asset values we found can be written in linear replication form as functions of other asset values. Second, we found that the Bachelier model, of course, Bachelier never discounted the risk-free rate. That's the one thing he was missing, right? He used the futures price to do the mean distribution, so it's got the risk-neutral mean, but he hasn't got the risk-free discounting. So after you do that, you discount the risk-free rate, you get the modified Bachelier model, and this trick works where you can get the very nice corrected values. So the orange curves here are the corrected values. And you can see they have all the right properties, positivity and convexity. So you can get the Bachelier model is the model that is consistent with the CAPM under this change. And the same trick works for Black-Scholes. And if we want to calculate the value option, the option easily, what we do is we work with the risk neutral mean going forward if we're going to value some options based on these cash flows. Okay. We still haven't answered the question how to expand to multiple periods. So this is the paper I wrote at the end of last year, thinking it was going to be a specialized application on how to value cash flows for capital constrained companies. But I was trying to justify RAROC as a present value technique and how you apply RAROC to multiple period cash flows. But it turns out there's another application for that work, which is, the market portfolio also has the same characteristics as the portfolio I was describing, because it's a function of as I said, the total risk of the portfolio. So if you're willing to take the market portfolio or assume that about your reference portfolio, you can get this very nice result. So let's consider the cash flows produced by a firm's assets, one firm this time, over time. So we'll call it C1 to Cn. They're obviously multi-period, they're normally distributed, and they have a very rich intertemporal covariance structure. Where'd my pen go? There it is. So I can have correlations across time that can be anything, right? And then how do I solve this? I value this backwards. Originally, this was done by, who was it? Bogue and Roll did this with a CAPM. They showed that you could turn into a multi-period CAPM just through backward recursion. If you assume standard deviation utility, where you're taking a risk charge based on the standard deviation, what this does is it forces the expected Sharpe ratio to be constant each period. So it's kind of like discounting the cash flows, but instead of using the cost of capital, using the Sharpe ratio, which is the cost of risk.
So just about the term expected Sharpe ratio, should we read that as expected value of like future Sharpe ratios?
Right, so it means the expected value at time 0 of Sharpe ratios in the future.
Yeah, so why are they random in the future?
So because the cash flows may change, right? Actually, they might not be random in the future because the conditional covariance matrix is independent for the normal distribution of the outcomes of the cash flows.
Okay.
So that may not be, might have to be that strong about it. So this part is important because it's normally distributed. I don't have to solve it backwards, which is a tedious process. Because of this independence of the conditional covariance matrix, I can actually solve it forward because I know what the realized covariance matrix is going to be after some number of periods in this set. So trust me on that. You know, we don't want to do too many formulas in this this talk. But here we have, if I have cash flows C1 to Cn, I partition them into the ones I know up to Cj, and then there's the ones I don't know yet up to n. That partitions the mean vector. We can also partition the covariance matrix. And it turns out you can write the expected value of the unknown cash flows as a function of the known cash flows as equal to the original mean and plus this regression style updating. This looks like a regression coefficient, right? It looks like a covariance divided by a variance. So it's kind of like a regression, except that you have many y variables and many x variables. Then the covariance matrix, after you know the first j cash flows, you want to know the covariance of the remaining ones conditional on the outcomes. And that is a function which is not dependent on the cash flows. This was discovered by Isai Shor, an Israeli mathematician who was working in Poland in the 1930s. People use it in linear algebra a lot for like very complicated matrix inversion problems, you know, for block matrix inversions, things like this. It's a really useful tool mechanically, but here it has a really great meaning for me because it says how much risk is unresolved after each cash flow occurs. So what's the value of the cash flows at that time? So at time j, the expected value, and I set the interest rate equal to 0 just so that my formulas are cleaner now.
Okay.
Risk-free rate. It's very easy to add back in, but just to make it cleaner, I say at time j, my value of my asset is the expected value of future cash flows conditional on what I've seen, subtracting a risk charge, which is you can see it's the sum of all the elements of the covariance matrix, which is the same as the variance of the sum of the cash flows. So this is the expected future cash flows minus a risk charge times the standard deviation of the sum of the future cash flows.
Yeah, so I'm coming to my question. So if all the Cn are positive, like will this, you know, like let's say it's looking dangerous that you're subtracting, you know, something positive. And so you might, I'm thinking K is positive, you might get negative, you know.
Might. And in fact, if you do, it's because you should. So there's no limit to liability here, right? We can have contracts with negative values all the time. And even corporations, you know, they have assets that have negative values because they can't declare bankruptcy on an individual asset of the corporation. So I'm no longer afraid of negative values, for one thing.
Well, I'm not afraid of them, but I'm afraid of arbitrage. And
yeah. But these are not the other things.
I'll
They're not positive value because these are all normally
distributed.
Right,
the Cn are not. Okay, fair enough. I forgot the normal distribution. Right. Okay, so because of the normal distribution, the cash flows can be negative. Fine. Okay.
Yeah. And so at time 0, then the valuation is really, really nice. It says just take the sum of the means of the cash flows after discounting the risk-free rate, of course, subtract the Sharpe ratio times the standard deviation of the sum.
Great, but so, okay, but getting back to like call option valuation, if you were ever to do that.
We're getting there. We're getting there, I promise.
Okay, you'll get there. All right, so you know what I'm gonna say then. This wouldn't apply as written to call option payoffs because.
That's right. So what I'm doing now is I'm valuing the underlying asset, the cash flows of the company.
Okay.
The asset cash flows, without limit to liability, granted. And now I'm going to go and do the derivatives.
Okay, that's fine.
And here's the trick. In each period, the risk charge is based on the reduction in risk of the cash flows remaining. Because each time the risk goes down, There's some uncertainty that's being resolved, and so the value should go up by that amount. Okay, that's how the valuation works in this model, right? Because you always have the value is equal to, it's like a certainty equivalent. It's the mean minus the risk charge. When risk is resolved, the risk charge goes down and the asset value pops up by the reduction in the risk charge multiplied by the Sharpe ratio. So we can calculate now, getting to Peter's question, I can calculate a risk neutral mean. So I can say, if I take each individual mean and subtract this risk charge, this part here, I can get a risk neutral mean. And when I do this, it turns out that I'm going to have always positive cash flow results, positive valuations. And by the way, it's the same thing I did in Bachelier, right? If I took those, the first time I did, I got the D values that didn't work, and I got the negative values in the non-convexity. And then I replaced it with D star, which was this D now calculated with the risk neutral. And suddenly I didn't have any more arbitrage in the call option prices. Why? Because with risk neutral, there's not going to be any more risk charge. There's not going to be that linear subtraction anymore. Right? So let's put this in the context of a simple model. Here, I'm just going to take the asset value follows cash flow, sorry, not value. This is corporate cash flows for 10 years, follow a random walk. Okay, so they follow a random walk. There's the current value, the drift, the standard deviation, and so on. So what I want to do is figure out how much risk is resolved every year. So I have to calculate all the Schur decompositions of this matrix. It's the covariance matrix divided by sigma squared. So I have to multiply this by 100 to get the actual covariance matrix. Now I chose this on purpose because the Schur decomposition of this particular matrix is exactly the same matrix. And why is that? Because when you have a random walk, of course, every time you get a new realization of the random variable, the process starts over. The same drift, right? Same standard deviation, same covariance structure. Right? So what happens is after one period of time has passed, if you ask what is the covariance matrix for the remaining 9 cash flows, that's it. So I can know the total risk as of 1 year from now would be the sum of these times 100. And then after 5 years, right, then my remaining risk is this, my remaining covariance structure. So it's really a nice trick for, especially it's a lot in teaching because it's such a nice matrix to work with. And each time, so each period I can calculate the value very easily. There's no matrix inversion here, by the way. It's just matrix combinations. Expected value is equal to the mean for the random walk, which is growing at $5 per year. Subtract the Sharpe ratio, which is 0.6, times the standard deviation, which is the square root of the sum of these elements of the matrix. By the way, since I've been reading a lot of these old linear algebra books, you might like the name, the grand sum of the matrix. Something I ran into. When you add up all the numbers in the matrix, this does have a name. So the grand sum of a matrix is the sum of all the terms, or in other words, the variance of a sum of the random variables. So the expected value is very easy. Just what's the mean of the remaining cash flows, which is the sum of those, because I said the R is equal to 0, and minus the risk charge, Sharpe ratio, times the standard deviation. I got my value in each period. I could have stopped there, right? I could have said this is the value times 0. That's what I was after. But that's not really what I'm after because I still want to value the derivatives. So what I need to know is what's the risk neutral cash flow every year? What's the risk neutral mean? Because if I can simulate the cash flows using the risk neutral mean, then I don't need to take a risk charge. I can just find the expected values. Okay, so I now take all these means and adjust them, right, by subtracting that Sharpe ratio times the reduction in the standard deviation from one period to the next, and I get these risk neutral means over here. And as you can see, just as a test, the risk neutral means all add up to the current value. The discount rate is 0 in this case. The other test I did just to verify my calculations is that when I calculate the return, I always get back the same Sharpe ratio of 0.6 every period. Okay, interesting, huh? That was the assets, right? So now I'm going to go to liabilities where Peter wants me to go and say, how do I value these liabilities, which I'm characterizing as derivatives on the underlying assets of the company. It's okay. I'll take a simple case. I'll do a typical waterfall, if you will, but I need to first simulate the risk neutral cash flows. So to do that, I replace the means with the risk neutral means here. I just copy those from the previous slide. I've got the standard deviations from the arithmetic random walk, right? Square root of 100, 200, 300, and so on. I need to generate correlated random numbers. So I start with uncorrelated random numbers. I multiply by the transpose of the Cholesky decomposition of the covariance matrix. But that's the other good reason to use this particular model, because the Cholesky decomposition of this matrix is equal to the lower diagonal matrix of ones. So again, it's very simple. There's no inversion at all in this model. No matrix inversion. So there's no computational limit on how you can use it. You take your random numbers, you multiply times the inverse of the transpose of the Cholesky decomposition. You get the correlated random numbers. You generate the normally distributed results, the resimulated cash flows, and then calculate your waterfall. So I took the debt payment. So after interest, that's my income. I give 40% to the government, and equity keeps 60%, the typical simple waterfall. I have to add some though. I don't want to get a result where I just keep increasing debt, increases the value of the firm. And I wanted to couch this in an optimal capital structure exercise. So I also have a financial distress, which is imposed by, if the cash flow goes below the debt service in any period, it basically terminates the asset, so I get no further cash flows. So now I have these risk neutral cash flows being generated for the liabilities, but they're generated from the risk neutral mean. Therefore, you know the answer now. I can discount those at the risk-free rate. I'm back in my familiar Cox-Singer, Saw, and Ross world. Which is where I was very happy to begin with. Back in 1985, weren't we all very happy? So I promised you an optimization here. I was actually using this model in class, in my valuation class today, to show students how to find optimal capital structure using a simple model. So all my 6103 students can do this now, or maybe not all of them, hopefully 90% of them. Right? So basically, we could say, well, if I want to optimize the debt level, I want to see which level of debt is going to give me the highest combined value of debt and equity. And so I have 1,000 simulations because these are fixed cases of random numbers where the random numbers are fixed, so I can do a nice smooth optimization like this. Nice little simulation trick. And then I can find the value of equity plus debt is maximized when the debt level is 1,040. So now I've got an algorithm for determining the optimal debt level in a simple capital structure model, based on having either the simulated cash flows or knowing the distribution of the future cash flows, including their covariance structure. Now, I sold this to Peter when I changed the topic. I said I wanted to talk about this because I wanted to show him that I could value CDOs, using this new evaluation technology. And it turned out that the CDO is actually easier than the problem I solved, because I wanted to solve the capital structure problem, and the CDO valuation problem is just a simple version of the capital structure problem. Because what's a CDO? You have this trust that holds these bonds, and the trust issues claims against the trust. Class A, Class B, residual, whatever, right? So it's just the CDO is a very simplified capital structure model. So I can value that easily. This is a little harder, the capital structure of the firm, because you have to allow for the optimization of the capital structure as well. So if I were presenting this purely to practitioners, I would say at the end of this talk, here's some cool facts. Delta is a covariance divided by variance. It's like a regression coefficient, a static regression coefficient under the risk neutral measure. And I never knew that in grad school. I have to be honest about that. The option replication formula also applies to stocks. There's nothing special about stocks or options. They all have this kind of replication formula. If you model Google as a linear function of 10 tech stocks, I bet you get a pretty darn good fit. Just using linear relationships like this. The structural model I've shown you is completely consistent with the Sharpe's version of the CAPM, as I mentioned, and this model was first conceived by Lindner and Mosine. So the risk neutral pricing concepts that we're looking at can be applied to cash flows typical of corporate assets and liabilities, addressing all the challenges like we don't know the value, we have rich intertemporal correlation structures, we have very complex allocation rules. And like I said, CDO is a special case. If I was presenting this strictly to an academic audience, I'd say, I think what we've done in this paper is, first of all, we've resolved the apparent incompatibility between option pricing formulas and the CAPM of Lindner and Mosine. The second thing we did was we converted multi-period cash flows into risk neutral equivalents by assuming a constant Sharpe ratio per period, which is a property of the CAPM, by the way, in a multi-period setting. And here I'm thinking about a model like Stapleton and Subramaniam, like a multi-period version of the CAPM. Then I value corporate liabilities as options on the assets of the firm very easily, because since I knew the risk neutral equivalent cash flows, I could get the nice easy valuations. And finally, back to my 1985 dream world of Coxinger, Stahl, and Ross, I'm able to use a very simple algorithm to value these cash flows. And I could be given either simulated cash flows and compute the moments from those, or be given a theoretical distribution of cash flows and then just compute the statistics and value it from there. So I think that's it.
All right, well, thank you. I think I missed the part when you did options and kept the and avoided arbitrage. Could you just go over that again, please?
Okay, so because when you calculate this payoffs, there's nonlinear payoffs in that the allocations to the different instruments. These are nonlinear payoffs, right? And these payoffs are guaranteed to be positive through the waterfall calculation.
Okay.
So you don't want these to go negative. And why won't they go negative? The reason is because there's no risk charge anymore, because we're using the risk neutral means.
Okay. And but the way you're getting these risk neutral means, is it via a subtraction of a risk charge or not?
Yeah. Yes. So it's like the assets of the firm, but the assets are not assumed in this case to be, they're not protected by limited liability. So they could be negative because these cash flows of the assets are assumed to be normal.
Right. Okay, so here's the situation I want to address. That because it's a derivative, the cash flow is bounded below by 0. Okay.
Right, because of these types of derivatives, right? Yeah.
So then, like, I realize, there's no way you can assume a normal distribution for something non-negative. Okay. Right. So you have to do something else. And so I'm not following what you're doing.
Okay. I don't assume these are normal at all.
Okay.
I only assume that the asset cash flows were normal. So think of the asset cash flows as the underlying asset of the liabilities of the company. And the liabilities are nonlinear, complex nonlinear functions of the asset cash flows. So I'm not imposing normality here. I use the risk neutral mean of the assets, right, to resimulate the cash flows on a risk neutral basis. And I compute the waterfalls. The waterfalls are forced to deliver positive cash flows by definition.
Yeah. Okay. So it sounds like you're not doing anything different from classical derivatives pricing by taking expected values and risk neutral means.
That's right. But the
Okay.
difference is that I couldn't apply. It wasn't clear to me, and maybe someone can show me how I might have discovered this some other way. But I don't, I've done searches for, using the Sure decomposition in finance, and there's very few papers that actually do it for any application, not
I
just
think,
this.
yeah, I mean, I think it's fair to say what you're doing is instead of taking underlying asset values as given, you're deriving them from cash flows.
Right.
And, and let's say specifically from normally distributed cash flows.
Right. Multi-period and with potentially very complex covariance structures.
Okay, that's fine. All right, that's clear now. Thank you. All right.
So what do you think? Do I have two new findings or just one?
What are the two new findings?
Well, you said the first one, the suggestion of the different ways you could get Bachelier to be compatible with the CAPM. That was a new finding.
Yeah.
Is this new or is this just a
yeah, I mean, I've never seen anybody say that, let's say all you got to do is make option prices be convex and strike, and then suddenly you're free of arbitrage. I haven't seen that result, so you can say that's new. Is that what you meant?
Yeah. Okay, so I get 1 out of 2 then. That's all I wanted to know.
Oh, okay. All right. Yeah. Well, while we're on that topic, I mean, you also had something like del V del D equals 0. Is D the argument of the cumulative normal there?
Yeah.
Okay. Okay, that's fine. So that's in the Bachelier setting. So, yeah. Okay. Yeah, so I'm just trying to think I'm trying to understand how you're thinking about that. So you're thinking of like it's a partial derivative, and then the variables include D clearly, and S, the stock price as well?
Yeah.
Okay, so even though D would be written as something like S minus K divided by standard deviation, you're just thinking of D as anytime
D as the variable, right? So it's not like I derived the result. I just said, if I just decided to calculate the derivative of the Bachelier model with respect to that D argument, there's one place where it's equal to 0, and that's when in the risk neutral case.
Yeah, that's an interesting point of view. I mean, because let's say usually you think of D as a function of SK and sigma, yeah. But you're saying don't think of it that way. Think of D as an additional variable.
Right. It's kind of like Merton did these various transformations of the option pricing model. Sigma squared T or e to the minus RT or natural log of S over X e to the minus RT. Mm-hmm. So I think you can think of D as an intermediate variable as well, which is how many standard deviations away are you from the strike?
Definitely. Yeah. But let's say this function V that you're differentiating, its arguments would be, like, let's say SK, R, sigma, T, and D. Like you would be putting, even though D would be a function of SK and sigma and T, you're actually treating it as a separate variable on top of the others. D is. Okay. I mean, it's let's say that's an unusual point of view. So it's something new. Okay. All right. It's almost 7 o'clock. So I mean, anybody?
I've got a question. So actually, the Schur decomposition, I've seen that oddly enough in places where you're trying to get the conditional mean of something. Yeah. You know half the vector, and you want to get the other half.
That's right. Yeah.
Or not the other half. The other some fraction of. But it isn't in valuation typically that I've seen it. It's in most.
Right. That's what I'm saying. I have seen it before in other applications, but never in a valuation context.
Yeah. Yeah. The other question I'd have is, see, when you're valuing a firm as opposed to valuing a derivative, there's so much uncertainty in the cash flows and so on and so forth that I think it's worth checking your results against, say, a standard DCF type valuation. And I'll give you an example of someone who tried a very clever shortcut. You remember Fisher-Black's conditional discounting rule, discounted the risk-free rate? You get the conditional cash flows of a firm or a project. Then you discount and you just say, well, all right, I think I can figure out what the conditional cash flows are. And then if I believe in the CAPM, then I can say, look, if the in states of the world when cash flows are up, and let's say they're driven off the market, then I know the discounting rate's also high. It turns out that it's good enough to just discount by the risk-free rate. It's a clever idea.
Yeah, that might be, you know, I did something similar in my class when we did the CDO calculation.
Yeah.
Because we said, well, I want to know what the risk charge is. So why don't I just begin by just discounting everything at the risk-free rate and figuring out the relative risk of the different instruments.
Yeah.
You know, so I wasn't aware of the Fisher-Black reference. I'll have to look that up.
I'll dig up his the note that he had. It was, I don't think it was a formal paper. It's just a set of say half a dozen ideas. He says, look, I've got these ideas and I'm just going to write them up, and I'll dig them up and I'll send it to you.
Yeah, great. Thank you.
Oddly enough, it's used in things like the pharmaceutical business, where it is a complete crapshoot. And you say, look, something's better than nothing. But in the standard setting, and I do it in my valuation classes, let's try this out on Apple or some firm like you'll come with it sometimes in a factor of 2 or 3. Sometimes it's so off, it's not even funny.
Yep.
And I suspect you might find something similar out here. There'll be cases when it's actually within a factor of 2 and cases where it's off hugely, but it'll be hard to separate out when it works and when it doesn't work. There won't be an obvious dividing line. There wasn't an obvious dividing line for Fisher-Black simple discounting rule either.
Yeah.
You couldn't look at a firm and say, hey, this is the kind of firm for which it's going to be absolute nonsense. It's going to give you a bad answer. You couldn't look at it and say, hey, this firm is just, don't even try it. So it was a bit of a crapshoot, but it was the simple discounting rule was a very intriguing idea.
All right, so I'll look forward to getting that reference. Thank you.
I'll send it to you.
Yeah, I want to make a comment. So I guess you've been assuming, for the cash flows that they're normally distributed. And I understand that's a very flexible, friendly, analytically tractable distribution. I want to consider a different random variable that is also well understood. So it's called Bernoulli. So it takes values 1 or 0. And, so I'm saying, suppose a cash flow, and let's not do multi-period from the beginning, let's just do single period at first. Suppose at the end of a single period, a cash flow is either 1 or 0. And, we know the real world probabilities of 1 and therefore 0. And therefore we know the mean. And we want to come up with a price. Let's make the interest rate 0 to simplify our lives. We know we shouldn't just charge the mean. The price should not simply be the mean. We know that. So we need to, but we can start with the mean and do something to it. And let's say one choice is to subtract something from the mean for the risk. That's one choice. A different choice would be to divide the mean by something to get to the price. So, comparing subtracting for risk charge versus dividing for risk charge. And I'm going to argue there's an advantage for dividing, which is that, it could be that, let's say it was 0.5 probabilities just to work with numbers. So the mean is obviously 0.5. And, I could end up starting with a mean of 0.5 and subtracting 0.6 for the risk and end up with a so-called price of negative 0.1. And, that is an arbitrage because the payoffs are 0 or 1 and there's no way the price should be negative. So the alternative, again, of dividing the mean of 0.5 by a positive quantity will result in a number between 0 and 1. Okay. So won't induce an arbitrage. So where I'm going with all this is, let's call it the primacy of charging for risk via division, or multiplication. It just depends what you like, but as opposed to addition and subtraction. Okay. So as far as keeping things arbitrage free, there's a clear advantage to the multiplication division route for charging for risk than compared to the addition subtraction.
But on the flip side, I would say that, if someone came to JP Morgan and offered us a transaction which had an expected value of $1 and a standard deviation of $1 billion,
Yeah.
right? No discount rate I could ever use would ever get me to a value below 0. And I would say in those cases, like I know when, I had similar deals, they come to the street and not that big, obviously, but if you have a deal that, you go to Morgan Stanley, and I actually did this with Morgan Stanley with the deal. So I go there and I want them to take this deal, and it's a fair value deal, but they have to charge me a risk charge for it because there's so much risk. So they don't get a positive valuation for it, and they were just taking advantage of me. Every bank on the street would give me a negative value for that deal.
Right.
The high risk associated.
So where we are is, let's say, I've got a cash flow where multiplication division is preferred because because my cash flow takes value 0 or 1, and you got a cash flow that is on the reals, and then you're saying addition and subtraction is preferred, right?
Yeah, there you go.
Yeah. So okay, so let's say maybe we should think of it as you use the appropriate binary operation for the appropriate type of cash flow, right? So it's not one size fits all.
There you go.
Yeah. Okay.
But it seems like some of the theoretical work I read on pricing kernels, they just assume that it's like multiplicative, the discount is multiplicative, and it seems to me that has not been sufficiently examined to the point where that should be considered.
Yeah, like I'd say, right, that should only be done in the case I was in where all cash flows are non-negative, right?
Yeah.
Okay, right. Okay, very good. All right, let's wrap up. Let me sure you can stop recording. Thank you, everyone, for attending.
Thank you.
David,
Okay.
I've sent it to you. In fact, a
Thanks,
bunch
James.
of papers. I've sent you
right.
a bunch of
Awesome.
papers related to Fisher-Black's, 2 by Black and 2 comments on it, 2 commentaries on it.
He's also, Fisher-Black was one of the 2 economists who ever, brought up the point that you need to diversify your risk across time as well as across assets.
Mm-hmm.
The other one was Tobin. And, I also think that, it's strange that was never, made a big deal about in finance, that we never really talk about, diversification over time.
Yeah. Well, the time diversification puzzle is, it's generated its share of heat, if not light, because the stocks for the long run was, that argument propped up hugely.
Yeah. But anyway, it just made me think this project made me think about that, and too, because they're looking at the cash flow risk not only across assets but across time as well.
Yeah.
When you look
I'd say insurance companies definitely diversify across time, right?
That's for sure. In fact,
Yeah,
they cash flow match in many cases.
Yeah. So,
talk about correlated cash flows, right? After hurricanes, they actually raise their premiums to make the most money.
Yeah.
all right. Thank you. All right.